What is up? This is the Working Investor. In this video, we're going to talk about something that I feel like not enough people think about, and I feel like smarter people that I speak to do think about this. I think about this. It's called dividends. When is enough, right? Because you think that more money, cash money coming in every week or every day they have now dividends, or every month, every quarter, the more the better, right? Not necessarily the case, and this is why I am making this video. I want to show you some highlights that not always is more dividends better. As always, nothing is financial, tax, or legal advice or any form of advice. This is purely for fun and entertainment purposes. Please see all my disclaimers. So let's look at the pros and cons of dividends, right? So basically, obviously, the pro is, this is what I believe, that the dividends gives you freedom and security now. Security now, time now, I believe is worth more than time in 50 years from now. When you're able-bodied and able to do things and you don't have the morbidity of older age, a lot of people age very gracefully and take care of themselves, and they have a very good quality of life up until the last year, or ideally last minute. And some people age horribly and they don't take care of themselves. It could be a combination of what they do, lifestyle and genetics, or bad luck, and they age horribly, and time later on, things that they're pushing off on their bucket list later on may never come. And the worst thing you want to do is regret. So time today to be able to pursue your dreams and passions, whatever it is, and have a choice of how you want to spend your time is worth much more than later. And not just that, having the income now, even if you're still working your regular job or whatever gig you're doing nowadays, that security that if something ever happened, you got the household covered, you got your cost of living covered, that gives you a lot less stress and anxiety at night. And you could work and do the best you can in peace. They've done studies of people who work and they don't need the income. They're actually better and more honest workers because they work because they really enjoy it. They're not so, it's almost like a dishonesty because you're working because, not because of the love of the work, but you're working because, you need the money. It's literally transactional, but you want to have a job that you enjoy what you do, and it has more integrity if you don't even need the money, and the money's kind of a cool plus. Another pro, which kind of goes into what we're talking about, is called emergency flow. So I call this the emergency flow. I don't hear people talking about it. It's a term that I came up with. So there's something called an emergency fund and an emergency flow. An emergency fund basically gets depleted. Let's say you put 10K or 20K, whatever it is. Let's say you put 6 months of cost of living in there. If something ever happens, you have 6 months of time to get another job or find another venture to make more money in order to cover yourself. The problem is you have this thing weighing in on your shoulders that is it basically depletes itself. It's a depleting asset, and once it's gone, you feel like you're on the clock, which is good if you need to motivate yourself, but it gives you much more peace of mind because bills don't come one time. Typically, bills are recurring every single month or so, right? So if you have an emergency flow that gets replenished like a tree that you can harvest every season, every cycle of the year, then you feel much more calm because as the bills come, your income is coming to offset and fight those bills on a recurring basis. So I find that way more optimal, in my personal opinion, to have an emergency flow than an emergency fund. I think most of you guys would agree with me about that. And then, of course, taxable income. Now, why did I put this in the pro section, and it's also in the con section? So is taxable income good or bad, right? So here's the thing. Some people who have a lot of passive income, they want to get a loan. Let's say they want to buy a home and they want to have proof of income. So you have to look into this further and speak to your accountants and maybe your financial advisor. There are certain types of dividends that basically is considered taxable income. And if it's consistent, you may be able to use it as, oh, look, I am receiving income, and now you could possibly take a loan against that income. I'm not a tax expert. I would think possibly, tell me if this makes sense to you and you got to look into this. Maybe if you have dividends or proceeds that come as labeled as return on capital, is very good because it typically return on capital I would understand is not taxable until you get your return of capital. But on the other side, if you're trying to prove you're having income, to pay to get a loan for a mortgage, then if it's taxable, then you know what I mean. Then you don't want to have return on capital. You want to have taxable income. So you got to look into this further. But there could be a pro there. On the con side, many times, not always, but quite often, there's a trade-off. Quite often, when you go for the income funds, you may be giving up total return. Let's say you have two types of funds you want to put your money into. There's a growth fund and there's like a dividend fund, a high dividend fund. Not always, but sometimes you're giving up. If you look at the 10-year horizon, total returns, you add the dividends and the growth together. A lot of times you don't get the same return, right? If you put the same if you're not using the income and you put the $10,000 into a certain fund, after 10 years, you may have 30 grand on one fund. It may have tripled, 3x. And on the income fund, let's say, for example, it may have 2x in total return basis. So you could be losing total return. There are a lot of cover call income ETFs out there as well. And think about cover call income ETFs. It's very good. You derive income from the volatility of selling calls, right? But then you're also capping your potential upside. And there's also problems with something called whipsaw when the market goes down really quick and then reverberates and the pendulum swings and jumps up really quick as well. Quite often you see historically when the market goes down sharply, one of the best days in the markets come right after those real sharp downturns. As you've seen as an example, Exhibit A in April of 2025. So basically, you have to be mindful that you're possibly giving up a little bit of total return, putting it in maybe like assets or maybe other assets. And then also like taxable events. Now, when you get dividend or distributions periodically, every week, some give, every couple times a week, every month, whatever, you could be getting a taxable event. Sometimes you could be getting like short-term capital gains. Sometimes it's qualified versus unqualified dividends versus ROC, 60/40 rules. There's a lot of different ways. There's a whole a whole big world to go into here. But when you're getting distributions, there's a big chance you could be getting a taxable event every single period that you get the dividend distribution. Versus if you had it in growth, if you don't need the income, you could potentially get a better return if you have it in growth, and you are in full control when you want to trigger that taxable event, aka when you sell the asset. You could decide you want to do it after a year in a day to get long-term capital gains versus less than a year. You know what I mean? So you have that, that type of control versus let's say you have a REIT, and I understand that REITs, real estate investment trusts, for example, are taxed as ordinary income, which is the worst type of tax. So again, like I said, all my disclaimers, speak to your accountant, but you have, so that's kind of the cons with the dividends, taxable. And then there's something called sequence of return. So basically, but that's more, actually, you know what? I would say I put it in here because there are some funds like XPay, which is a round hill product, which you may suffer from sequence of return. Sequence of return, honestly, is more for non-dividend funds, I would say, that don't do ROC, because sequence of return is basically when, let's say the 4% rule, when you sell, 4% of your income, throughout a year. So let's say you have 100 grand. So you basically will be able to derive $4,000 over the year. So that's called the 4% rule. You divide it by 12 months. So you take, a tiny percent of it every single month. The problem is when the market's down and you take your distribution, you're selling your stocks for a much worse price. You're not getting a good bang for your buck. You want to sell when the market's up. So you kind of suffer from sequence of return. So some funds like XPay, which basically just give you back your money, you have that kind of issue. But then there's also like other stuff like return on capital. But that's a whole different mode hole. Anyways, let's get on to the next slide. Now, you're probably wondering what's my thought process, and tell me if this is your thought process or if you have a different thought process. So I think that there is a value for income, even if you give up some stuff like some upside and some total return. There is some value of income until you've met your goals, right? And and these goals could be either a income replacement. So you're looking at how much you're making on your 1099 or your W-2, and you want to see if I can replace that entire income. That would be cool. Or some people look at it a different way. Let me just see what my total cost of living is if you live within your means and not at your means or over your means, hopefully not. And then if once you cover that, then whatever happens, you have your cost of living covered. Maybe that could be some people have those goals. So it matters most until you get that emergency, you're self-sustainable, you're financially free, I guess, in whatever definition you term is for you a healthy financial freedom. And then I would look into, once I've met that goal, then I want to go ahead and put everything into like other stuff. I'm looking for total return, I'm looking for diversification and hedges and everything else. I'm looking at the whole holistic part of the portfolio, not income as an isolation. I'm kind of doing a bit of a hybrid, but mostly I went very heavy, chunky into the income, and now I'm kind of diversifying out a little bit with the growth. But I'm gonna may go back into the income until I've achieved my goal. So I'm kind of doing it like a little bit of a stepwise fashion. Now, another thing I think about with income, and I've spoken to many investors, and a lot of them come to this sort of similar to this conclusion, that let's say whatever your income goal is, let's say your income goal is $3,300 a month to cover your cost of living. I don't know, whatever it is. So the goal is not to get $3,300 to cover your cost of living, $3,300 a month. You want to 3x that. Why do you want to 3x that? Because you truly want to have the 3,300 to spend to cover your cost of living, but you have to put into consideration taxes. I don't know, everyone's tax situation is different. I don't mind, I'm not telling you I pay 33% taxes, but it's a good idea to put, a rule of thumb. You can speak to accountants to get your particular specific circumstance. But about a third, or I would say roughly, is a good take to put away for taxes, just in case so you don't get surprises at the end of the year. And hey, if you saved up too much, then it's almost like you put money into a special area for taxes, earmarked for taxes, and if you have too much for your taxes and you cover it, now you have like a little bonus, consider like a refund because you didn't have to pay all that for taxes. And then another third, you want to reinvest or divest to continue on my diversification and my hedges. So why do I want to reinvest? There's two major reasons. Number one, I don't know if you guys notice in the store, in the grocery store, everywhere you go, tuition, wherever you go, housing, you could fill in the blank. Everything is going up in price all the time. We've seen it more in the past few years. The rate of inflation has been mental. You have to I'm getting my head spinning with how high the prices are. So, and I don't even think that most jobs even keep up with that. So you're trying to preserve your buying power. So I need to constantly keep growing the income just for the pure sake that, my cost of living today will be covered tomorrow. Because if it's not keeping up, then yeah, it's not going to be it won't be able to keep afloat, and that will remove the whole security. So inflation mitigation is number one. And number two, I'm sure you guys know, not all funds have very consistent dividends. Of course, ideally I love funds that have consistent dividends, and then even better, consistently, slowly increasing their dividends month over month or year over year. It slowly goes up. Those are awesome. And that's why I like funds that pay dividends that actually go up at NAV, because if a fund, let's say, pays 25% yield, or you know what, give me a fund that gives me even 12% dividends distribution. That's the goal, right? In dividends, not total return, just dividends. Then the fund also grows a nice amount every year. So next year, it's still targeting, let's say, 12% in dividends, but because the value of the stocks went up in price, the amount of the dividends is more because it has to reflect 12% per share, annualized per share. So those are awesome. So, but sometimes we have funds that fluctuate. Some months they're more and some months they're less. And and even market cycles, if the market cycle goes down for a few years, then your dividends may go down for a few years. So there is some inconsistency and some unknown. So I want to keep investing and overshoot the goal a little bit to basically anticipate these inconsistencies, so I don't have any surprises down the road. You want to wait for Murphy. I know I've been going on for 50 minutes, so this is my last slide, and I really appreciate you, and I want to give you a present here with some last really cool points. So my last point is, don't get blinded by the money, the dollar signs. I see a lot of investors, and I respect everybody's pathway. I'm not making fun of anybody, but I see a lot of people in my mind. I critique them, positive critiquing, because I see myself just like that. I was also there as well. They get blinded by the money. They see, okay, I'm making $10,000 a month. I'm making $20,000 a month. Yeah, you made $20,000 a month, but there's a lot of other things to consider, right? $20,000 a month sounds great, but if you have an account that's worth $100,000 and it went down to $70,000, and that's after getting $20,000 total and not using it, reinvesting it, and your net account balance is now 70 grand. Now you lost your total return is your net down 30%. And that $20,000 that one may have gotten, right? They would have been down 50. They'd be down to 50,000, but the 20,000 brought them to 70,000. So now they're net down 30%. But then that 20,000, they have to definitely pay some kind of taxes on, some, at least some portion of it. So they're down a little further. So be mindful about NAV erosion, total return. Look at the total return. If you have a fund that, if you want to compare funds, and you're looking at basically, in a nutshell, you're looking at the dividends plus the growth of the underlying, that gives you the total return. So look at the full picture, right? Look at the tax burden, some tax implications. When the dividends, what are they classified on the 19A forms? Are they 60-40, 60, I think it's 60% long-term capital gains and 40% short-term. So it's kind of like a blend. Long-term capital gains more favorable than short-term. Is it return on capital? Is it ordinary income? Like, what is the tax burden? So that helps you calculate the total. It actually helps you with total return, your total return after taxes. And then also, people get very blinded with these incomes. I see a lot of people love. I'm going to give you an example, Misty. And hey, I'm not going to knock Misty at all. I've had Misty in the past. It pays amazingly, but people are overweight. So they're putting a lot of very high concentration in one asset. I mean, I don't know, but you can speak to any financial advisor. I'm sure they would tell you putting very extreme high concentration in any given asset has a potential of risk. So you have to look at, not, sometimes it's worth to, maybe go for a lesser income, because you're getting basically diversification. If the market cycle changes and money flows from, cryptocurrency to gold, or it goes from crypto, to real estate, or it goes to other defense. So if you got money in all of these different sectors, the money will flow into you. From one thing will go down, different thing will go up. So diversification can help. People, also keep your eye on the hedges. Make sure you're hedged out. So there's all kind. We can go into this for a long time about hedges. You can do, buy in versus, or do shorts versus long, or you could do different sectors. Diversification could be a form of hedging as well. So then also on the right side, focus on the management. A lot of these funds are actively managed. Now, when it comes to active management, it puts another layer of consideration to look into. See, when it comes to typical funds, you want to look at what's inside the fund. What does the fund comprise of, right? And how do they structure it? How do they rebalance it? What do they go for? What are their metrics, screening methods? But when it comes to these actively managed funds that are being traded, option trading, future trading, whatever it may be, going for momentum, you want to look at how they manage it. And then you want to look at, the fee, and you may want to, I look into diversifying. I like to diversify my managers as well, because you can have 2 smart people. You can have 10 smart people in the room talking about one topic, and they have 20 different opinions. So who's the right one? I don't know who's going to make you the most money. So sometimes I may hedge my bets and kind of go, instead of putting all my money in one, I kind of maybe put it on a few and break it up a little bit. That's how I look at it. I have a video on parallel diversification. I'll link in the description. And then there's like, obviously keep an eye on the fees. Sometimes there's lower, so you can have two funds that are equal, but one has a higher fee, one has a lower expense ratio. So, hey, I know it's a little bit of money, but it adds up over time. I consider that as well. And then look at this, like I said, look at the strategy, especially when you're starting to layer on derivatives and rebalancing and futures. Look at the strategy. Are they doing calls? Are they doing puts? Are they short? Are they long? Are they doing strangle straddles? They're doing this, there's so many things, they're doing leaps with put spreads, jade lizards, reverse jade lizards. I can go on here forever, but look at the strategy. And I like to personally balance out. Like if I see, every strategy has pros and cons. Like if you think of a soccer game, right? There's defense, there's offense, there's the goalie, right? Every single person has a a role to play. And you don't want to have a soccer team just with goalies. That wouldn't do too well. You don't want to have everyone just offense. That wouldn't be too well. So you want to see the strengths and weaknesses of every single strategy. And I like to take two different funds I would, let's say, get, and I look at one fund that the strengths of one fund is the weakness of the other, and the weakness of the other is the strength of the other. So they work in harmony. So in my portfolio, I have a blend of the two. So I look at strengths and weaknesses and match them up, so as a nice partnership. Anyways, this is the Working Investor Overnight. I hope you guys have a wonderful trading week. All the best. Be well.